Hi there. Today we are going to be explaining what temporary buydowns are. These loans have become very popular in the current marketplace in a rising interest rate environment. So quite simply, a buydown is like paying a fee up front to buy a lower rate for a temporary time period, unlike paying discount points, which actually buy down the rate permanently. When you pay points to go, from example, from 7 to 6.75, you pay a fee up front and the rate stays at 6.75 for life. But a temporary buy down is buying a fee over a short-term period, temporary buy down. All right, so here are kind of the options, right? There's what's called a 1-0 buy down. The one refers to the first year, and then the second one is the remaining years. Then 1-1 would be year one, then year two. 1% for the first year, then 1% for the second year. A 2-1 buy down would be a 2% discount in year one, then a 1% discount in year two. And then going back to the original base term from there. 3-2-1 would be a 3% discount in year one, 2% discount in year two, and a 1% discount in year three, and then returning to the base rate again. So for example, assuming your base rate is 7%, the 1-0 buy down means 6% for year one, then 7% for 29 years. A 1-1 buy down, 6% for year one, 6% for year two, 7% for 28 years. 2-1 is 5% for year one, 6% for year two, 7% for 28 years. 3-1, again, probably making sense now, is 4%. So 3% from 7%. So 4% for year one, 5% for year two, 6% for year three, and then 7% for the remaining 27 years. The cost of the buy down is simply the payment difference from the lower rate compared to the base rate, times 12. So basically 1 year for each year bought down. So depending on the choice that you choose up above. So again, a quick example, and I'm going to show you an Excel spreadsheet in a moment, but a $750,000 loan at 7% is $4,989. At 6% or 1% lower, it's a payment of $4,496. That's a savings of $493 a month times 12 equals $5,916 for the buy down for that 1 year. So the 1-0 buy down, that would be your total cost. But if you're doing a different one, the 1-1, the 2-1, or the 3-2-1, then you need to calculate the payment savings for each year to the buy down and then add them all up to arrive at the total buy down cost. It can be paid for by the seller, the buyer, or the lender through premium pricing, which basically means they increase your interest rate to pay for that expense for you. Okay, so now let me quickly go over to a spreadsheet and show what it kind of looks like. A lot of numbers here. Don't get stuck in all the numbers. Loan amount, same example, $750 loan amount, purchase price of $800,000, which is not critical. 7% interest rate, payment of $49.89. Right, so let's say you do the 1-0 buy down, 6%. The note rate payment again was $49.89. $4,496 is your bought down rate. $493 a month times 12, $5,917. So it can be paid for by the seller, and that's the credit they'd have to give the buyer to buy it down. Or if you did it with the lender, your interest rate would probably go up to cover that expense here. But I wouldn't worry about that. That's not all that common, although it can be done. I'm going to go all the way down to the 3-1 buy down. So again, remember our base rate is 7%. So 4% year one, $49.89 is our existing 7% payment. So we're saving $1,400 a month, $16,900 for the entire year. 5% for year two, again, $963 a month, so $11,500 for that year. 6%, you're saving $493 as we showed in the other one, so $59.17. So that's the equivalent of about $34,000. So if you can get a credit for $34,000, you'd have a payment, this lower payment for year one, year two, year three, and then back to the base rate for the remaining 27 years. If you want to pay for it from the lender side, I guess it gets quite expensive. It'd probably add, quite a bit. So I won't even go into all that. So hopefully that helps you understand it. And we're happy to help you determine if this makes sense or not and who's going to pay for it. Thanks very much. This is John Thompson, founder and lead advisor at SMPL Mortgage.